Okay, hi everybody, this is Mr. Manning, and this video is going to be about what corporations do in the second step of the accounting cycle, which is record transactions into ledgers, but they use these things called subsidiary ledgers. So we're going to talk a little bit about why they do that and how it's different than small businesses. So, if you remember back to when we were discussing accounting for small businesses, we talked about this thing called the accounting cycle, and it's got 5 stages. So stage 1 is recording the transaction into a journal. For corporations, they use special journals like the purchases journal, the cash payments journal, the sales journal, and so on. Step 2 of the accounting cycle is then taking those transactions and recording them into ledgers. And whenever we were doing small business accounting, we use this thing called the general ledger. And for small businesses, that usually is just fine because they don't have a whole bunch of accounts. And because they're a small business, they probably only have a handful of accounts receivable and accounts payable accounts. Quick reminder, accounts receivable is companies that owe us money, and accounts payable are companies that we owe money to. So corporations are different. They're really, really big companies, and they probably have a whole bunch of accounts receivable and accounts payable accounts. Think about a company like Walmart in particular. So Walmart gets a lot of different merchandise from a lot of different places, and when they order that merchandise, most likely they order it on account, and then they pay back those companies later. So they probably have a list of hundreds, maybe even thousands of accounts payable accounts. And on the flip side, there would also be a lot of companies that owe them money because they purchase things from Walmart and then promise to pay them back later. All right, so I think you get the point. Corporations have a lot of accounts payable and a lot of accounts receivable accounts. So in order to keep this somewhat organized, they use these things called subsidiary ledgers. And the word subsidiary means that it is related to the original, but maybe not quite as important, or it is smaller. And that's basically what this is. A subsidiary ledger is still a ledger, but it is only used for a very specific purpose. So in our class, we will only be using subsidiary ledgers that are for accounts payable and accounts receivable. All right, so why do corporations use these ledgers? And I've already kind of mentioned it's because they have way too many accounts payable and accounts receivable accounts. They need to keep all of them in one spot. Quick reminder again, remember whenever we went to, when we did small business accounting, after the second step, ledgers, we went to the third step, which was the worksheet, and we recorded all of our accounts on the worksheet. Well, imagine a company like Walmart that has thousands of accounts payable and maybe thousands of accounts receivable. That worksheet would be enormous. So once again, this is why accountants do this, is it's just more efficient, and it allows them to have much easier to understand documents. So it would be inefficient to record every single account on the worksheet, the balance sheet, and the income statement. All right. So they use these things called subsidiary ledgers. It summarizes all of the activity for accounts payable and accounts receivable into one thing. And then when it summarizes it into one single number, one balance, that balance is then transferred to the other documents. It's transferred to the worksheet, the balance sheet, and the income statement. So where do you get the information to record into a subsidiary ledger? And the answer is you get it from the journals, just like you did with small businesses. When we did ledgers with small businesses, we took all the transactions that were listed in the general journal and we recorded them into the ledgers. Corporations do the same thing, except for that they have special journals to look at. So they need to look at the transactions from the purchases, from the sales, from the cash payments, from the cash receipts, and the general journal, and then take those transactions and put them into the ledgers. The good news for you is whenever you're using a subsidiary ledger, you are only looking for a very specific type of account. So if you are using a subsidiary ledger for accounts payable, I can go through all of the journals and I can only look for transactions that had something to do with accounts payable. In particular, and there'll be more about this in a video whenever we discuss accounts payable subsidiary ledgers specifically, but the purchases journal has transactions that deals with accounts payable. So does the cash payments, and the general journal can. But you'll notice that the sales journal is not listed here and the cash receipts journal is not listed here. The reason that is because those journals will never have a transaction that has anything to do with accounts payable. So when the accountant is recording an accounts payable subsidiary ledger, they don't even have to look at those journals because they know that there's no transactions that are related. When does this happen? It happens at the end of every single month. So these transactions get sent into or from the special journals. They get put into the subsidiary ledgers. The accountant keeps track of all of the ledgers for every accounts payable and accounts receivable account. They update the balances throughout the month, and then at the very end of the month they create this thing called a schedule of accounts payable or a schedule of accounts receivable. And the word schedule is just a fancy term for list. And that's really what it is. It's a list of every single accounts payable or accounts receivable along with its current balance. And we will do one of these together in another video as well. But I wanted you to understand that it's just a list of all of them with their balance. At the very end of that list, you total them all up. You get a total of accounts payable, and then that's the number that you put into your other documents like your worksheet, your balance sheet, and your income statement. Okay, guys.